Welcome to our latest analysis. We're the Gambling Databases research team, and our whole mission is to deliver these in-depth, data-driven breakdowns of the global iGaming landscape.
Exactly. We dig into the regulations, the tax, the player experience, everything you need to really understand how these markets work.
And today, we are zeroing in on a market in West Africa that presents one of the most fascinating contradictions we've seen in a while. We're talking about Guinea.
It's a genuine paradox.
Yeah.
I mean, on the one hand, you have this immense future potential, but it's trapped. It's completely trapped by some very harsh economic realities right now.
Understanding that tension is just.
Hmm.
It's absolutely critical if you're even thinking about market entry. It is the ultimate high-risk scenario.
But with the risk side, heavily outweighing the reward at this point.
For sure. The executive summary really nails the contradiction. On one side, Guinea offers an exceptionally low operator tax rate.
And an incredibly young population. They're super mobile savvy, ready for digital products.
But then you flip it over, and the foundational risks, the economic barriers, the infrastructure gaps, the regulatory mess, they're profound.
It's like a brick wall blocking all that potential you just mentioned.
Okay, so before we get into tearing down that wall, let's just lay out the key metrics, the essential stats. We're looking at a population of about 13 million people for 2025.
And this is the most important number, I think. The median age is a strikingly young 19.5 years.
Wow, 19 and a half.
Yeah. To put that in context, the median age in the U.S. is around 38. So this is a population of true digital natives.
Exactly. And the infrastructure, well, where it actually exists, it shows that readiness. Mobile penetration is over 70%.
Which is high for the region, definitely.
But even with all that, our overall market attractiveness rating for Guinea, it's at just 4.5 out of 10.
It's emerging, no doubt. But those barriers we mentioned make profitability, for now, pretty much a non-starter.
So we have to start with the rules of the game, or maybe the lack of them. Let's talk about this regulatory maze.
Right. The core issue here is that Guinea's regulations are officially described as being in a formative and developing stage.
That phrase alone should be a massive red flag for any large, compliance-focused operator.
It just screams legal uncertainty. Now, to be clear, it's not a total free-for-all. National lotteries and retail sports betting, physical shops and kiosks, they're established.
They've been around, they have rules, even if they're a bit opaque sometimes.
But the second you want to launch an online platform, you hit this critical gap. Online gambling is technically legal, but online casinos, they operate in what our report calls a legal gray area.
And that's not just a fancy term. It means there is no formal regulatory framework, nothing tailored to remote platforms, data security, or online player protection.
So when a company wants a license, the ministry just processes it under general commercial laws.
Okay, so what are the actual practical implications of that? If there's no specific gaming law, you're basically operating at the mercy of some bureaucrat's interpretation.
That is exactly it. The risk is the lack of codification. It means an operator could be shut down overnight or have compliance requirements change suddenly, arbitrarily.
With no specific gaming law to fall back on for an appeal, you have no certainty.
None. And that leads us to the big governance red flag. Guinea lacks an independent gaming regulator.
Everything is centralized. So licensing, oversight, disputes, it all goes through the Ministry of Economy, Finance, and Planning.
And that centralization creates what we call variable procedural transparency.
Which is a very polite way of saying the process isn't predictable.
Right. If you're a foreign investor, you can't just download a checklist. You have to navigate the bureaucracy, which, adds huge indirect costs.
So if you need certainty, this is not your market. But there is one huge bright spot we mentioned, the sole strength, really, taxation.
This is what keeps the conversation going. The tax structure is designed to attract capital. The GGR tax is a minimum 3% turnover tax.
Which is one of the lowest rates you will find anywhere in the world.
Anywhere. Corporate income tax is a standard 25%.
And, crucially, for getting players involved, there's no direct tax on player winnings currently reported.
Right. That low hurdle for the player, it encourages smaller, more frequent bets.
So on paper, you've got this holy grail, low taxes, and a young, digital-first demographic. But we still gave it a 4.5 out of 10. Why?
Because tax only matters if there's money to tax. And if we move from the regulations to the actual economics, the whole picture just collapses. This is the economic reality check.
Yeah, this is where the numbers deliver a shocking dose of reality. The national economy itself is the big limiting factor. Nominal GDP is only around 14 billion US dollars.
And the GDP per capita is brutally low, about $1,060 in 2024. Household incomes are just crushed by high inequality. You're targeting a tiny, tiny sliver of disposable income.
And that reality creates a tiny addressable market, even with positive growth forecasts. And we are forecasting a healthy 8 to 12% CAGR.
You're starting from basically zero. Current market revenue is estimated at only about 15 million US dollars.
And that's supporting a user base of only around 200,000 active gamblers out of 13 million people.
And here it is. Here's the number that stops all the big operators in their tracks. We analyzed the average revenue per user, the ARPU. It's estimated at only $28 US dollars.
I say that again.
$28 annually.
$28 a year. Let's just sit with that for a second. What does that challenge even mean? Your average player generates $2.30 a month. How do you build a business on that?
You can't. I mean, it dictates everything. Marketing, retention. In developed markets, operators spend hundreds of dollars to acquire one player. Here, if you spend more than a few bucks, you will never, ever see a return.
So you're forced into micro-scale, hyper-local marketing.
Yeah.
Viral stuff, low-cost affiliate models.
Forget about big bonuses and high-end tech stacks. It's just impossible to justify.
You can't run a major operation on a $28 annual ARPU. We estimated the basic operational costs. Licenses, servers, a small staff would run conservatively between $20,000 to $40,000 a month.
Now connect those costs to the revenue. The total revenue pool is simply too small to cover those high fixed costs. The economics are, and we said this explicitly, prohibitive for most operators.
We estimate a break-even is at least 3 to 5 years. Minimum. And that's if everything goes right.
The market is just too small for medium or large companies right now, full stop.
And then those challenges are compounded by the infrastructure gaps, which brings us to the digital divide. Because even if a player wants to spend their $28, they need stable access.
And access is a fundamental hurdle. Internet penetration is only about 40%, and that's all concentrated in a few urban centers.
Relying on mobile networks, right?
Yeah.
Often patchy 3G or 4G.
And outside those cities, you hit the real failure point. Intermittent power supply. You can't run a reliable remote gambling business if the grid itself isn't reliable.
Latency, dropped connections. That's a nightmare for player experience and for your support costs.
Now, if banking penetration is under 20%, meaning 80% of the population is unbanked, how do they even pay?
Mobile money. It has to be.
It's the only way. Digital transactions are completely dominated by solutions like Orange Money and MTN Mobile Money.
So as an operator, you must build your entire payment system around these specific mobile wallets. Forget about credit cards.
Exactly. And that reliance on mobile money creates its own problems, doesn't it? You have transaction fees, micro-fraud risks.
Right. The operator often has to absorb higher costs on those platforms compared to traditional banking. It's another small bite out of that already razor-thin 28-day ARPU.
So let's talk about that target player. We know they're young, mobile first. With such little money, what are they betting on?
Sports. It has to be sports.
Sports betting, yes. European football, mainly. It dominates participation, about 65% of all activity. Lottery is a distant second. They want high excitement for a very low stake.
But here's the most important fact for market sizing, the exclusion reality. 60% of the population has no internet access.
And 80% are unbanked.
Those two numbers just...
Yeah.
They instantly collapse the potential user pool from 13 million down to a few 100,000.
Which reinforces that tiny active gambler figure we mentioned earlier. It explains exactly why the market is so small.
Okay, and just quickly on compliance.
Yeah.
If you do get licensed, you still have obligations.
Oh yeah, the ministry still expects the fundamentals. Robust age verification, KYC protocols, AML monitoring, and you must provide self-exclusion tools.
So even with a formative rulebook, the basic international standards for responsible gaming are still expected.
Definitely.
Okay, let's synthesize this. We have this massive contradiction. Guinea is, on paper, a long-term speculative powerhouse. It has the demographics, the mobile readiness, the low tax rate.
But it is completely locked down right now by three things. Extreme poverty leading to that mathematically impossible ARPU.
Inadequate infrastructure power and internet.
And that profound regulatory ambiguity, especially for online casinos, which have no real legal framework at all.
So our final verdict is that the economics only work for niche micro-operators. Or maybe deep-pocketed speculators willing to lose money for 5+ years just to get a foothold.
Yeah. If you're a casino-focused brand or you need ROI inside of 5 years, this is a market you must avoid.
But the really fascinating part, the thing that explains how business actually gets done there, it ties back to that governance red flag we raised.
Yes, this is where you get into the real nature of how things work in developing markets.
The report says operators have to navigate variable procedural transparency, and it explicitly notes that local partnerships can facilitate smoother regulatory engagement.
That's highly coded language. It's telling you how to navigate this uncertainty.
And it raises a really important question for you, the listener, to think about. When a regulatory framework is still formative, when the laws aren't really written down, how much does success depend on codified law
Versus navigating the informal governance structures. It's about securing the right local relationships to get approval and, more importantly, stay operational.
It completely shifts the risk. Instead of hiring lawyers to analyze statutes, you have to invest in building trust and political capital.
You're operating in an environment defined by relationships, not the strict rule of law. And that informal structure is both the biggest risk and the highest barrier to entry.
A market that is just bursting with potential, but where success today depends on understanding local dynamics, not just the balance sheet.
A fascinating place.
For the full text of this report and all of our other country analyses, you can visit our website at gamblingdatabases.com.
We look forward to breaking down the next market with you soon.